Hi, in this video I'll be exposing to you the moving average trading strategy. I'll be showing you why your moving average trade execution always fail and what you can do different in order to avoid losing trade using the moving average entry confirmation. So the moving average you are seeing on my screen first is my indicator, which is my Bollinger band. The period is 130, deviation is 2.0, shift is 0, and you apply to close. After that, I have my moving average. The period is 25, shift is 0. The method is exponential. You apply to close. Then I have moving average. The period is 10, the shift is 0. The method is exponential as well. Then here is my relative strength index, as you can see, and my commodity channel index. Alright, so before I continue, I want to say shout out to all our new subscribers. Thank you for your support to this channel. Thank you for liking the video. Thank you for your comments. And if you are coming across this channel for the first time, please do well to hit the subscribe button and do not forget to turn on your notification bell so you don't get to miss any of our video. So if you have done your setup correctly, your chart will be looking exactly like mine. Now, this is not peculiar to only this indicator setup. Regardless of any moving average you are using, this is applicable. First, let me begin by telling you that one of the challenges you have or the deficiency of moving average or indicator is that number one, it is not suitable for a ranging market. So whenever price is ranging, it is not suitable for moving average. Like in this scenario here, there is no clear movement of this price based on indicator trading. So if you want to trade this based on indicator alone, you will definitely lose money. This is not suitable. But if only you are trading this zone as your zone of price action, support and resistance, it will actually be a great advantage for you. Trading the zone as support and resistance. Alright, so if you are using indicator alone, it is not suitable for a ranging market. But look at in this scenario, we have a trending market, and indicator is best used and effective when the market is trending, being it an uptrend or a downtrend. And if you look at the name, it is called moving average, which means that a moving market. And a moving market is a trending market. A moving market is a trending market, right? A ranging market is a consolidating market. A consolidating market is not a moving market. Alright. So for that reason, you should know that most of the indicators are not designed for trading a ranging market. Number two, on your indicator window, like me, I'm using RSI and CCI. In your case, if some use Bollinger band, every other form of MACD, other oscillators, other volumes indicators like Bill Williams and the rest, you must avoid trading overbought and oversold zone. Overbought and oversold zone. What do I refer to as overbought and oversold? For instance, price is at this 90 and 80 level, you now decide to say, okay, this is an overbought zone, so let me sell. That is a very wrong way to trade. As far as trading is concerned, there is nothing like overbought and there is nothing like oversold. So please always take note of that. Let me show you a scenario. Think it should be on boom 600, right? Good. Now can you look at this? This is boom 600. So if you were to be doing overbought and oversold zone, look at here, you would have said this is an overbought zone. You buy, but look at what is happening. The price is still selling. You went and buy, price is still selling. So you can see for how long price has been in this place. So there is nothing obviously like overbought and oversold zone, right? So let's take note of that. Then number 2, I want you to take note of is take note of the space, the gap between your moving averages. What is the space, the gap between your moving averages, regardless of your moving average setup or whatever indicator you're using on your main chart? What is the gap between them? You can see the gap between this moving average and the middle Bollinger Band. See the gap between the two of this moving average. You can see there is a clear gap. So the more the space between this moving average, the stronger the trend of the market, right? And secondly, anytime you see price magnetize to the lower Bollinger Band, it shows you the strength of the trend. Okay, it shows you the strength of that trend. And let me add a disclaimer to this. We trade the middle Bollinger Band as an exhaustion point, the upper and the lower, in a scenario where it is in line with the structure and we are trading it as a pullback, okay, not as a reversal. So please, let's take note of that, right? If you don't get that, I would have loved to explain so that you can get that correctly. Let's say for instance this zone, let's look for this zone on the lower time frame. Beautiful. Now you see that zone that I marked. Remember I said when price is around the upper Bollinger Band is through the strength, but when you are trading in line with the trend and price pull back to upper Bollinger Band on the 15-minute time frame, and that upper Bollinger Band is your point of interest, is your order block, or you mark it as any of your point of interest, it means that you are using it as a dynamic support and resistance. And you can see how price was rejected from there and is sold back. So you are trading it as a pullback and as a sell confirmation. Okay, so now that we have said all of that and we have explained that the more the space between these two moving average, the stronger the signal of the trend. So by all means, take note of all of this and apply it accordingly. Alright, now how do we now trade it? If I am to trade, how do I use my moving average? Remember, most of the videos you come across always tell you that when the moving average crosses each order to the downside, you sell. And when it crosses each order to the buy side, you buy. Now, they are correct and at the same time they are wrong. So what is the right thing to do? This is the right thing I want you to do. The right thing is when it crosses, you do not sell. When it crosses, it's just like a change of direction. So you will need a confirmation. The confirmation is for price to make a retest. So anytime you get moving average crosses each other, you can on your own pick up your reference line. Just connect it to where that price cross, because once that cross happens, price has already turned to the downside. So you pick up your trend line and place it as a reference line. Then what next? You wait for price to come and pull back to retest the moving average, or retest the reference line, which is the trend line that you have drawn. So you see now price will come back, pull into the moving average for the second time. That is when you will now be looking for your entry. And when price pull back, you won't just jump into making an entry. You will need a candlestick confirmation in order to make that entry. And in this scenario, we are having a pin bar candle formation. So you see that pin bar becomes your entry confirmation, or you use this bearish engulfing candle to make your entry confirmation inside your moving average. And you see that it coincides with the middle Bollinger band. Alright, so that is how you will find your entry on the 1 hour time frame. And if you want to make this entry based on 15-minute time frame, let's move to 15-minute time frame and look for exactly where that entry happens. Beautiful. If you are to make this entry on a 15-minute time frame, you are having a divergence. So this is your divergence confirmation, and you will be in that beautiful sell trade. So it's a divergence confirmation and as well as a bearish flag pattern entry confirmation. So you can see that, and again the price pull back again, give you another pin bar. That becomes your entry number 2. And remember, we say this strategy is suitable for a trending market. So look at this, price went out of it, but eventually price closes below it. So it's another sell entry, and you can see how price keeps playing in that direction. So in this scenario now, we had this cross. So price have crossed here. So what do we do? What exactly do we do? Price moving average have crossed. So what do we do? If we must buy now, we must wait for price to pull back into our moving average. So when the price pull back into this moving average, we will now look for a bullish candle formation, right? So we want to see a bullish pin bar, right? A bullish pin bar or a bullish engulfing candlestick pattern, and then we can go to our 15-minute to get a divergence confirmation strategy. And I believe this video will change your trading career and you have learned something new. Please do not forget to like, share, subscribe, turn on your notification bell so you'll be the first to get notified when we upload our next video. And there is a link in the description of this video where you can join our Telegram channel for free signal. And if you are interested in enrolling for a mentorship class, you can reach out to us following the link. Thank you, and see you in the subsequent video.